The Turkish lira just hit 35 to the dollar, a new all-time low. The Argentine peso is trading at 1,200 to the dollar on the black market despite reform promises. The Egyptian pound was just devalued 40% in a single week. This is not random. This is the pattern that always precedes global financial crises. Emerging markets break first, then the contagion spreads to developed markets. Then everyone realizes the monetary system itself is failing, and we're in phase one right now. If you want to understand how emerging market currency crises predict what's coming to developed markets, subscribe now and see the global pattern. Let's establish what's happening across emerging market currencies and why it matters for everyone, not just people in those countries. Emerging market, EM, economies are countries that are industrializing and growing, but don't yet have the financial stability, reserve currency status, or institutional strength of developed markets. Turkey, Argentina, Egypt, Brazil, South Africa, Indonesia, Thailand, these are classic emerging markets. They share common vulnerabilities. Dollar-denominated debt. They borrow in dollars but earn revenue in local currency. Commodity dependence. Many are commodity exporters, so they're vulnerable to price swings. Political instability. Governance is weaker, corruption higher, policy less predictable. Capital flight risk. When crisis hits, foreign investors pull money out fast. Limited monetary sovereignty. They can't print dollars, so they can't solve dollar debts by printing. Right now, multiple EM currencies are showing severe stress simultaneously. Turkey. The lira has lost 95% of its value against the dollar since 2008. Inflation is running over 60% officially, likely higher in reality. Erdogan's unorthodox monetary policy, cutting rates while inflation soars, has destroyed confidence. Argentina. Despite Javier Milei's shock therapy reforms and chainsaw approach to government spending, the peso remains unstable. The black market rate is double the official rate. Capital controls are still in place. Inflation, while declining, is still over 200% annually. Egypt. The government was forced to devalue the pound by 40% in 1 week after IMF pressure. Reserves are critically low. The country is dependent on wheat imports, paid in dollars, and tourism collapsed during regional instability. Brazil. The real has been volatile, swinging 15–20% against the dollar in months. Political uncertainty, fiscal deficits, and concern about central bank independence are all weighing. South Africa. The rand is weak and getting weaker. Power grid failures, political dysfunction, and capital flight are all accelerating. This is not normal volatility. This is crisis-level stress across multiple countries simultaneously. Here's the mechanism that turns individual EM currency problems into global contagion. When an emerging market currency starts falling, it triggers a vicious cycle. Step 1. Currency falls. Let's say the Turkish lira falls 20% against the dollar. Step 2. Import costs spike. Turkey imports energy, food, industrial components, all priced in dollars. Those just got 20% more expensive in lira terms. Step 3. Inflation accelerates. Higher import costs feed into domestic prices. Inflation rises. Step 4. Real wages fall. Workers demand raises to keep up with inflation. If they don't get them, purchasing power collapses and consumption falls. Step 5. Economic growth slows. Falling consumption means businesses suffer. GDP growth slows or turns negative. Step 6. Debt service becomes unbearable. Remember, many Turkish companies and the government itself borrowed in dollars. The lira falling 20% means their debt just got 20% more expensive to service in real terms. Step 7. Default risk rises. If they can't service debt, default becomes likely. Credit ratings get cut. Borrowing costs spike. Step 8. Capital flight accelerates. Foreign investors see the death spiral forming. They sell lira assets and pull capital out, which pushes the lira down further. Step 9. Currency falls more and the cycle repeats, accelerating. This is exactly what happened in the 1997 Asian financial crisis. Thailand's baht collapsed in July 1997. Within months, Indonesia, South Korea, Malaysia, and the Philippines all saw their currencies collapse 30–50%. The contagion spread because investors realized, if Thailand can break, so can Indonesia. I better sell now before everyone else does. That same contagion dynamic is forming now across Turkey, Argentina, Egypt, and others. Now let's talk about why this matters for the United States, Europe, and developed markets that think they're insulated. Emerging market crises don't stay contained. They spread through 3 channels. Channel 1, trade disruption. When EM currencies collapse, those countries can't afford to import as much. That means less demand for developed market exports. German manufacturers sell machinery to Turkey. US companies sell tech to Brazil. When those currencies collapse, orders dry up, global trade contracts, developed market growth slows. Channel 2, banking exposure. European and US banks have lent billions to emerging markets. When those loans go bad, it hits bank balance sheets in New York, London, Frankfurt. In 1997, Japanese banks had huge exposure to Southeast Asia. When the crisis hit, it contributed to Japan's lost decade. In 1998, Russia's default triggered the collapse of long-term capital management, a massive U.S. hedge fund, which nearly crashed the entire global financial system. Channel 3. Flight to safety. When emerging markets are in crisis, capital flees to perceived safe havens. Traditionally, that meant U.S. Treasuries and the dollar. But now, with U.S. debt at $36 trillion and the Eurozone in crisis, Video 9, there are no truly safe fiat currencies, so capital is flowing to gold instead. This is why gold has been rising steadily even as EM currencies collapse. It's not just EM investors buying gold, it's global capital recognizing that all fiat currencies are vulnerable. Let's go back to 1997, 1998, and understand how EM crises escalate into global crises. July 1997. Thailand devalues the baht. Seems like a local problem. August 1997. Indonesia, Malaysia, Philippines currencies all collapse. Regional crisis. October 1997. Hong Kong stock market crashes. Taiwan devalues. Contagion spreading. November 1997. South Korea's won collapses. Major economy in crisis. IMF bailout required. January 1998. Indonesia's rupiah loses 80% of its value. Political crisis. Riots. Suharto falls. August 1998. Russia defaults on its debt. Ruble collapses. September 1998. LTCM, a U.S. hedge fund with $4.6 billion in assets and $1 trillion in derivatives exposure, nearly fails. The Federal Reserve has to organize a private sector bailout to prevent systemic collapse. What started as a Thai currency problem became a global financial crisis that threatened the entire system. The key lesson: emerging market crises are early warning signals, not isolated events. They reveal which parts of the global financial architecture are weak, and once the cracks appear, they spread. Now, in 2026, we're seeing the same pattern form. Turkey, Argentina, Egypt, these are the Thailand, Indonesia, and South Korea of today. The question is, what happens next? Does it contain, or does it spread? History suggests it spreads. Here's the irreversible dynamic that makes EM currency crises so dangerous. Emerging markets collectively owe over $13 trillion in dollar-denominated debt. That's debt that must be repaid in dollars, not local currency. When local currencies collapse, the real burden of that debt explodes. If the Turkish lira falls 50%, a Turkish company that owes $100 million now needs twice as many lira to service that debt. Many companies can't handle that. They default. When they default, the foreign banks that lent to them take losses. Those banks then tighten lending everywhere, not just in emerging markets. Credit conditions globally deteriorate. And here's the worst part. Central banks in emerging markets can't solve this by printing money. They can print lira, pesos, or pounds all day long, but they can't print dollars. And since the debt is in dollars, printing local currency just causes inflation without solving the solvency problem. So they're trapped. They can either defend the currency by raising interest rates to 30%, 40%, 50%, which crashes the domestic economy, let the currency fall and watch inflation explode, and debt become unpayable. Both options are bad. There's no good choice. This is what forces IMF intervention, and IMF bailouts come with conditions: austerity, spending cuts, tax increases, privatization. Those conditions are politically toxic. Governments fall, social unrest rises. We're watching this play out in real time across multiple countries. So what does this mean for you as an investor or saver in a developed market? You might think, I don't live in Turkey or Argentina. This doesn't affect me. Wrong. Here's how EM currency crises reach you. Impact. 1. Your emerging market investments get crushed. If you own EM stock funds, EM bond funds, or international equity indexes with EM exposure, you're getting hit. Even if the underlying companies are fine, currency losses destroy returns for dollar-based investors. Impact 2. Your bank's exposure to EM debt creates systemic risk. If your bank lent to Turkish or Argentine companies, those loans are going bad. The bank's balance sheet weakens. In a crisis, weak banks freeze lending, which slows the economy and hurts everyone. Impact 3. Global risk-off means correlations go to 1. When EM crisis escalates to global crisis, everything correlated to financial system stability falls together. Stocks, bonds, real estate, everything except gold and cash gets sold. Impact 4. Capital flight benefits gold. When investors flee EM currencies, where does the capital go? Historically, Treasuries. But with U.S. debt at $36 trillion and the scenarios we've covered in previous videos, Treasuries are no longer the obvious safe haven. Gold is emerging as the primary beneficiary of EM capital flight. That's why gold is rising while EM currencies fall. It's not just inflation, it's capital fleeing broken fiat systems with nowhere else to go. Let's talk about what sophisticated investors do during EM currency crises. Strategy 1. Short EM currencies, long gold. This is a classic macro hedge fund trade. When you see multiple EM currencies in death spirals, you short them and go long gold. The short position profits from the currency collapse. The gold position profits from safe haven flows. It's a hedge trade that works in both crisis escalation, both legs win, and crisis resolution, they offset. Strategy 2. Avoid all EM exposure entirely. During 1997-1998, investors who stayed out of Asia saved themselves massive losses. EM stock markets fell 50-70%. Currency losses added another 30-50%. Total losses for dollar-based investors were catastrophic. The smart money exits EM at the first signs of contagion and waits for the crisis to fully play out before re-entering at much lower prices. Strategy 3. Increase developed market safe haven assets. Even if you think U.S. Treasuries are problematic long-term, they still function as short-term safe havens during acute EM crises. Smart money increases cash and gold positions while reducing equity exposure and EM exposure entirely. Strategy 4. Buy EM assets after the crisis, not before. This requires patience. But the best returns in EM come from buying after the currency has collapsed, the IMF has intervened, reforms are underway, and sentiment is at max pessimism. In 1998, investors who bought Korean stocks after the crisis made 10x over the next decade. But buying before the crisis resolved was a catastrophic mistake. Here's the moment of absolute clarity about what EM currency crises mean. The global monetary system is a pyramid. At the bottom are emerging market currencies, Lira, pesos, rand, rupiah. In the middle are secondary reserve currencies, euro, yen, pound. At the top is the dollar. When the pyramid starts crumbling, it crumbles from the bottom up. First, the weakest currencies break: Turkey, Argentina, Egypt. We're here now. Then, the contagion spreads to larger EM economies: Brazil, South Africa, Indonesia. Then, it reaches secondary developed markets: Europe, already showing stress via ECB crisis; Japan, debt bomb waiting to explode. Finally, it reaches the dollar itself, the top of the pyramid. This process takes time, years, not months, but it's a one-way process. Once confidence is lost, it doesn't come back easily, and the only asset that sits outside the pyramid, that doesn't depend on any government's solvency or any central bank's credibility, is gold. That's why gold rises throughout this entire process. It rose during the 1997-1998 crisis. It rose during the 2008 financial crisis. It's rising now as the 2026 EM crisis unfolds. And it will keep rising as the crisis spreads up the pyramid toward developed markets and eventually the dollar itself. The people who understand this, who see that EM crises are not isolated events but the opening chapter of a global monetary crisis, are buying gold now. While it's still under $3,000, while most people are still debating whether inflation is transitory or whether the Fed will cut rates, while the mainstream narrative is still, everything is fine, here's your action plan based on what EM currency crises are signaling. Step 1, exit all emerging market exposure immediately. If you own EM stock funds, EM bond funds, or individual EM stocks, sell them. This is not a long-term call that EM is uninvestable. It's a tactical call that the crisis is in early stages and will get worse before it gets better. You can always re-enter after the crisis resolves at much better prices. Step 2, increase gold and silver allocations to 15 to 25% of portfolio. The EM crisis validates everything we've covered in the previous 12 videos. Central banks buying gold, dollar system stress, currency debasement, supply shortages, all of it is being confirmed by the EM crisis. Now is the time to move from considering precious metals to actually building the position. Step 3, reduce equity exposure, especially in sectors with EM revenue. Consumer discretionary, industrials, materials, many of these sectors have significant EM revenue exposure. When EM demand collapses, their earnings get hit. Rotate toward defensive sectors or reduce equity exposure overall. Step 4, hold some cash for opportunistic buying. When EM crises escalate to global crises, there are always forced sellers creating opportunities. High-quality assets get sold alongside junk because funds need liquidity. Having 10-20% cash allows you to buy those opportunities when they appear. Step 5, monitor the contagion spread. Track which countries are next. Watch credit default swap spreads. Follow bank stock prices in Europe and the US. The crisis spreads in predictable patterns. You can see it coming if you're watching the right indicators. The Turkish lira is at 35 to the dollar. The Argentine peso is at 1,200. The Egyptian pound was just devalued 40% in a week. This is not random. This is the pattern. Emerging markets break first. Then the crisis spreads to larger economies. Then it reaches developed markets. Then everyone realizes the entire fiat currency system is failing simultaneously. 1997 started with Thailand. By 1998, it had spread to Russia, Brazil, and nearly crashed the US financial system. 2026 is starting with Turkey, Argentina, Egypt. Where does it spread next? Brazil, South Africa, Indonesia. Europe is already showing stress through the ECB crisis. Japan is a debt bomb. The dollar is the last domino, but it is still a domino. And when emerging market currencies are collapsing at this scale, it's telling you the global monetary system is breaking. Not tomorrow, not in one dramatic crisis, but systematically, predictably, from the weakest currencies to the strongest. And the only asset that survives this process intact is the one that central banks are buying, that billionaires are accumulating, that has survived every currency crisis in 5,000 years. Gold. The EM currencies are the canary in the coal mine. They're dying. The question is whether you'll heed the warning and get out of the mine, or whether you'll stay and hope the gas doesn't reach you. History says it always reaches everyone eventually. Position accordingly.